Good day, everyone. Garrett with More Financial Management here. Wanted to share with you an update on what's going on with the economy, the investment markets, and then, of course, how that all might affect your personal finances. So, the one thing that's been impossible to miss this year is the performance of the U.S. stock market. It is up approximately 16% year to date, as measured by the S&P 500. So, I really wanted to talk about that. Why that's the case, and then, of course, the implications going forward. This is really a story of the Federal Reserve. So, the Federal Reserve is, of course, the central bank of the United States. They set a certain interest rate and they heavily influence all other interest rates, including the rates that you and I earn and pay. So in order to understand how they fit into this and the market, let's go back to 2021. If you recall, inflation was really, really bad. That was primarily the result of the stimulative measures that had to be put in place by the Fed, by the government, in order to keep the economy afloat during the COVID lockdowns. In order to combat that inflation, the Federal Reserve had to start raising interest rates rapidly. The big idea being that if you can make it essentially prohibitively expensive to borrow money in any capacity, as far as a mortgage, an auto loan, or for your business, well, then you can quell demand and you will probably stop inflation, was the general idea. We are now seeing that has largely worked. This is a chart of inflation. You can see that in mid 2022, it peaked at around 9%. The good news is that it has been steadily declining since then, and we are presently right around the Fed's target of 3%. Okay? So that is good news. I do not want to be tone deaf to the plight of the American consumer. This does not mean that prices are coming down. It merely means that prices are no longer increasing at the astronomical rates that they once were back in 2022. As I said, we are now at that 3% level, which is what the Fed is actually aiming for. Okay? That has really brought us full circle. So this is a headline recently from the Wall Street Journal. Jerome Powell, the chair of the Federal Reserve Board, is openly stating that they are getting close to cutting interest rates. Okay, so whereas in 2021 they were rapidly raising them, they are now getting ready to cut them. Because as we just saw, the fight against inflation has largely been won. And as we are seeing in headlines, as of right now, we are getting soft job reports. So the labor market is loosening up. So now basically the Fed needs to reverse course and start making adjustments thereafter. Okay? It is largely the anticipation of these upcoming interest rate cuts that has driven the stock market to where it is today. Of course, cutting interest rates is very stimulative. If you can make it easier for people and businesses to borrow money, they're probably going to do so, and that's going to generate activity in the economy. And thus, the run-up that we've seen in the stock market is really the anticipation of that happening in the future. Okay. Now, with markets being near all-time highs, this is a fantastic time for me to remind everyone that the next decline is a matter of when, not if. I can assure you it's going to happen. I have no idea how bad it's going to be, nor when it's going to occur, but I assure you it will happen. Being conscientious of that fact will hopefully make it easier to deal with when it finally gets here. Okay? Setting expectations and really putting figures on this. Intra-year stock market declines of 10% are the norm. That is, when we look back through time, look at the data sets, that is the average. Okay, so you should fully expect in any given year, the stock market portion of your portfolio could very well be down 10%. Okay, of course, if we see a recession or a depression, it could certainly be much worse. All right, this is a wonderful chart by Carl Richards. He does these incredible sketches. So if we think of this line as the market, we all have a propensity to become greedy at market peaks. We want to, in fact, then buy into them even more, kind of perpetuating that long-term upward trend. Euphoria is often a word that gets used in this situation. Conversely, it is very easy and just perfectly natural to become very fearful when markets are declining. And then, ironically, we all have a propensity to want to sell, okay, at that point. And then Carl quips that you only have to do that a couple of times until you're broke, okay? So certainly what we're trying to avoid here. So really the end goal, I think, is prudence, right? The ability to be reasonable and rational. All right, so when we're up here at market peaks, euphoria, that's not going to go on forever. We should not extrapolate that out and believe that we are all going to become rich beyond our wildest dreams to whatever hot stock exists out there. Conversely, when the market is declining, we should probably not perpetuate that out either. It is probably not a doomsday scenario. Your portfolio is probably not going to zero. You are probably not going to be destitute. Okay? Instead, prudence. Okay? Now, this is a wonderful stat by First Trust. This is the probability that you will experience a positive return from the U.S. stock market on any given day. Is really only 53%. Of course, that's barely better than random, barely better than a coin flip. Okay, what this means is that you really need to tune out the day-to-day noise. Whatever the headline is on Fox News or CNN Business or CNBC or whatever it is that you watch, you probably shouldn't be putting too much weight in that. Okay, you should tune it out. All right, it's just random noise. It is not until we start extrapolating our time frames out that this becomes less of a gamble, okay, and more of a strong probability, okay, more of an investment as opposed to a gamble. When we look at a 1 year time frame, there's a 77% chance that you will have experienced growth by investing in the US market. Over a 10-year period, that jumps to 97%. Okay? All that is to say, as Warren Buffett put it far more eloquently, the stock market is a device for transferring money from the impatient to the patient. Okay. Now, we can talk a little bit about the nitty-gritty, about the market forecast, expectations going forward. This is from Vanguard's most recent market forecast. I'll draw your attention to two key areas. At the very top are U.S. equities, the U.S. stock market. So for the foreseeable future, they only expect U.S. stocks to return approximately 4% per year. Obviously, that's much lower than what we've seen year to date, and that kind of goes hand in hand. Markets are all cyclical. What worked phenomenally well in the recent past is likely to not be the best option going forward. Okay. Conversely, Vanguard is expecting international stocks to return almost twice what the U.S. Is expected to. Okay, this is why I think it's so very important to also diversify portfolios on a geographic scale as well, so that we are ensuring that we have these international investments and that we can capture these gains if this does in fact materialize. Okay, that's really it for today. I hope that was helpful. As always, I'm here for you. If you would like to chat in any capacity, please just reach out and I would love to do so. Thank you very much. Have a wonderful day. Bye-bye.